if you own an oil well or you wrote a book and it consistently sells $100,
stocks,
or dividends,
annuities, all of it.
Yeah, a huge amount of money in a bank account, and you're getting $10,000 a month in interest. Then don't buy real estate. You don't have to because you're already financially free at that point.
Welcome to the Old Fashioned Real Estate Show, where hosts Brian Leverage and Jeffrey Holst pour out old-fashioned real estate advice.
Hello and welcome to the Old Fashioned Real Estate Show. My name is Jeffrey Holst, and this is
Brian Leverage.
Brian, good to see you again.
Likewise, Jeffrey. It's been a while.
We're back where we started.
Yes.
This very couch.
This same couch, different wall. And
that's true. We were over
there before. A little bit
before.
better technology setup, too.
No, I think when we had the camera on top of a box.
Two boxes.
When I say camera, I mean my cell phone on top of a box. and the footage was like this far off. Yes. Yeah, it was amazing. If you want to go back and watch episode 1 through 3, I can't actually put all 3 of them up there, but if you want to, you can. Anyway, we have a very great topic today. Brian came up with this amazing idea. Why don't you tell us about it?
It's the 4 ways to financial freedom.
That's close.
Right?
That's close.
Through real estate.
Yeah, 4 steps.
Four
but
steps.
You were close. Yeah.
4 ways, 4 steps.
4 steps to financial freedom through real estate, and we're going to do it right now.
Yes. So your mentor, Robert Kiyosaki, taught you all of this, right?
No. I will say this about Robert Kiyosaki, though. If it wasn't for him and this awesome picture of me and him together, can we do that? Is that something we can do? We can put a picture of me and him.
Send me the picture.
I will, and you can put it right here in my hands. Awesome.
Yeah.
All right, cool. I got to be over on this side so you can see me. All right. Anyway, so if it wasn't for Robert Kiyosaki,
make sure it's not trademarked first. Yeah.
It's fine.
Yeah.
It's fine. The worst that they can do is kill us.
Mm-hmm.
I don't think that would happen. It's not trademarked. I
so
assure you.
Bob.
So Bob and I were hanging out, and he was teaching me all about how to be financially free. No, the truth is, though, the Rich Dad book, Rich Dad, Poor Dad, which if you guys haven't read it, you probably should, made a huge difference in my life because it changed how I looked at this stuff. This is not taken directly from that, but it is, related to it. And I know you've also read Rich Dad, Poor Dad.
Yeah, in addition to a bunch of his other books as well. I think before we really get into it, though, it'd probably be helpful for the audience to define what is financial freedom.
Sure. So the way that I'm defining financial freedom is actually borrowed from the Rich Dad concept, and that is when your passive income exceeds your living expenses.
Yep.
So that's it. I mean, if you have income coming in that exceeds your expenses so that you can work if you want, but you don't have to, then you've achieved financial freedom. And we kind of break that down into 2 different categories of financial freedom. And this is the step 1. You have to figure out what that number is. Like the first number is the minimum amount that you need to survive.
Yeah,
just
I'd agree with that.
Pay your mortgage, pay your car payment, or if you don't have those things, pay your living expenses,
all of it.
Just the basic minimum number that you need. And that might be a few $1,000s a month, it might be $10,000, it just depends on your budget, but it's the minimum number that you need to achieve financial freedom. That's the first number. The second number is sort of like what the comfort number, right? It's the number where you're not just paying your bills. You can also go to the movies. You can go on vacation. You can jump in your helicopter and fly to the beach, whatever it might be.
Yeah, that's a really comfortable number.
Well, yeah, that's that might be a third number, right? Yeah. The dream number. But the thing is, every person gets to decide at what level is their minimum budget, and you can adjust that, right? If you pay off your house, your minimum expenses go down. If you have a smaller house or you live in a less desirable neighborhood or something like that, that number can go down. So there's 2 components, right? It's not significantly different than net operating income in that way. You can either increase the income or you can decrease your expenses. Mm-hmm. But once you get to that point where your expenses and your income are equalized, anything above that, you're financially free. So the goal is to understand what that number is and to figure it out. And the way you calculate that is to do a budget. Mm-hmm. So you've done a budget, I'm sure, and you can tell us exactly how much you spend on a monthly basis.
Well, that's an entire show in itself, but it varies from person to person, right?
Obviously. Yeah. So let's just say, for example, and we'll move to the second point, the second step in finding financial freedom, which is, building a plan. Let's say that you know what your number is. And just to be simple, let's say your basic number is $5,000 a month, $60,000 a year.
Sure.
And let's say your comfort number is $10,000 a month, which is $120,000 a year, just double the amount. So if you were gonna try to figure out how to make $5,000 a month to become financially free through real estate, it would be important to understand how to get to that number. And that's really the meat and potatoes of this sort of thing, right? To borrow a stupid analogy, but it's the important part, is understanding how you get to $5,000 or $10,000 a month. So Brian, if you were doing that, how would you figure that out?
Well, I would first decide my initial steps, since we're talking about real estate, what types of real estate do I want to invest in?
Right. So we did a whole video on that, right? How to choose what asset class is right for you. Yeah. And we'll put that video right up there.
Sure. So it's a math equation essentially, right? If you can make, for example, $200 a month in cash flow from your average rental house, average being relative depending on what market we're in.
So the first thing you would do is you'd figure out what asset class you want to invest in, and then you would figure out if you bought that particular property, how much it would cash flow.
Exactly. And your cash flow is obviously you're covering all of your expenses and your debt service. And you want to be conservative with that because you got to account for things like depreciation over time. A lot of people don't do that because we're talking about
capital reserves and everything. Because if you're talking about retiring, you're financially free. You don't have to work anymore. If you're talking about that, you have to be able to build a plan that's going to last not for 6 months or a year or 2 years, but for the long term. So you're going to have to build in things like vacancy and turnover costs, and because you're going to have these properties support you over a long period of time.
Exactly. So if you can do that through your average rental house, let's say that grosses $1,000 a month, and after your expenses and your debt service, you're left with $200 a month. 5 of those is $1,000, and if your goal is $5,000 in cash flow, then you need 25
houses. Yeah, and it can be 25 houses. So the way I look at this is a certain amount per door, right? Yeah. So if you bought a duplex, that's 2 doors, or you bought a quadplex, it's 4 doors. And so if you can calculate down on your metrics to figure out what your average per door cash flow is, and again, this is just to be clear, it will change for every single person, right? It's not going to be like my average per door cash flow might be $200 a door, and that's pretty close to what we average. But if I'm buying cheaper, I might get more on one deal than another deal. Or if I'm buying for all cash, I should have a higher cash flow. Now my return on equity will be a little bit different, obviously, which is, and if you want to think more about whether you should leverage or not, we've done a couple of different episodes on that. And the one on the difference between return on investment and return on equity would be a great place to start for that. But the point is, you figure out what your average cash flow is, what you project it to do. And then from there, you come up with a number of doors that you think you need to meet that minimum threshold.
Yes.
In your example, it was 25 doors. Could be one 25-unit building, could be 25 single-family houses. Doesn't really matter. But once you figure that out, then you can say, okay, how long will it take me to buy my first deal? Or if I already have 3 doors, how long will it take me to buy the next one? How much money will I need? And then you can start building out a schedule for how this is going to work.
Yeah.
So that's how I would start thinking about that. And also another thing to think about too, when you're working on finding that financial freedom number, the number of doors is super important, but it doesn't have to be just from real estate. So if you have other things, like if you own an oil well or you wrote a book and it consistently sells $100,
stocks,
or you dividends,
annuities, all of it.
A huge amount of money in a bank account, and you're getting $10,000 a month in interest, then don't buy real estate. You don't have to because you're already financially free at that point. But the point is, you take all of your passive income and you subtract that from your budget, and once you get to 1-to-1 ratio, then you're financially free.
Yeah.
So you can build the strategy based on that. So then the second step, the third step is working that plan. So you've come up with a plan, you figured out you need 25 doors. What do you do next?
Well, this is where I think a lot of people fall off the path, so to speak, because real estate is a momentum-driven game, and it takes a lot of time to get that momentum going. Even, some people find their first deal very quickly. Sometimes it takes them a lot longer, a year, sometimes longer, anywhere in between. It just depends on the market and the individual. But you have to set goals that move you towards, I think you first need to define how long till you're financially free, assuming your expenses stay the same. And then you need to set goals that you periodically review that get you there in that time frame. So it's not enough to say, hey, I'm going to buy 10, 12 houses in my first year, with the idea that 25 houses get you to your end goal. You need to review your goals, I would say, monthly and quarterly as well, because you have to take action steps in between.
Right.
All designed to get you there.
Right, and those action steps are going to be things like analyzing deals, looking at deals,
networking,
for sure, and making offers. One of my good friends, Charles Dobbins, always says, he's a multifamily attorney, but he always says, if you're not making offers, it's just an expensive hobby.
Yeah,
right? You have to be making offers. That's a critical point in the in the process. And then you have to actually buy deals. So make offers, and then more offers you make, the more like you are to buy deals. And you've got to figure that out, right? So there's tons of steps to doing that. We've obviously talked about those on several of our other videos. But the point is, you have to, and I think to your point too with the momentum, you have to be realistic in how long this is going to take you. It's true that if you need 25 doors, you could be like Grant Cardone and buy a 30-unit building for your first real estate deal and
just first weekend.
Yeah, and just be done, right? But for most people, that's not realistic, right? Now, if you have $5 million in cash and you can go buy a big apartment complex, then yeah, you can be financially free the next day. But I'm guessing that the majority of our audience, the people that are watching this video, are starting from a point where they don't have
they're not financially free, which is why you're looking at this in the first place. And the odds are you're not sitting on the capital to just go ahead and deploy that and buy 3 houses within the first 6 months, let's just say.
Yeah,
right?
So you might, but and you take it a step at a time, which is really the fourth step to financial freedom, is to reinvest and repeat.
Right.
So what you're going to do is you're going to take all of your cash flow, and you're not going to live on it, right? The temptation when you buy that first rental property is to be like, oh, cool, now I make an extra $200 a month.
I can go a nice meal once a week.
Yeah,
say
absolutely.
Ruth's Chris.
Yeah, and we definitely do like Ruth's Chris, but we don't do it once a week anymore because of coronavirus, and we go twice a week now.
Yeah,
and then also. We didn't do it right away. I mean, I can't speak for you because I didn't know you when you bought your first property, but I'm guessing you didn't go to Ruth Chris every day.
No, I did go to Morton's after the first property. But
but that was to celebrate that. And I think there's real value. I have a really good friend who, anytime he makes a really good deal in real estate, he buys himself a new watch.
Yeah.
Go out and buy a Rolex or something.
Probably not a Seiko.
Yeah, no, it's a Rolex. He likes Rolexes. And so he'll do that when he maybe flips a house and he makes $50,000, and he'll say, I'm going to go buy a $10,000 watch. Yeah. You can reward yourself like that.
And you should.
Yeah, because you need the motivation to keep going. Because what you were saying at the beginning about how it doesn't happen instantly, if you're just like, oh, I need $10,000 a month, and I have $200 a month in cash flow, it doesn't feel like you're making any progress on it.
Well, and I want to go back to something you touched on earlier, is that as an investor who's been at it for a decent amount of time myself, and who's been involved with real estate investing organizations and so forth, I used to see a lot of people that come in and they would set goals for themselves that were maybe a little unrealistic, or not so much that they couldn't do it, but maybe the time frame in which they wanted to accomplish it was a little unrealistic. And that's sort of the moving target here, is that you always have to, I would say, reevaluate and readjust based on what you're doing, based on the results that you're seeing.
And you have to have realistic goals. I think it's great to make big goals. You want to be a billionaire. You want to have 1,000 units. Whatever that goal is, that's awesome. Yeah. I'm a big fan of that. But don't be unrealistic in the timeline. If you want to be a billionaire, which that'd be cool, I wouldn't mind being a billionaire, but I don't think I'm going to become a billionaire between today and tomorrow. And it's the same thing with real estate. If you want 25 units or if you need 50 units to get to your financial freedom number, whatever that number is, if you need to get there, don't expect to buy 50 units in 1 year unless you've already got 50 or 100 units and you have you have that process in place. It takes time, but there is a momentum thing, which is what you were saying earlier. If you keep reinvesting, which is that's step 4, right? Reinvest and repeat. At some point, you start refinancing. And when you refinance, you get a pile of cash. And then you can take that cash, you keep the cash flow from the deal that you have, and you invest that into a new deal. And now you just got a deal for free.
Right. And now your compounding really starts
and
to
if you and if you're letting the cash flow accumulate, you're going to start seeing cash build up in your account. You can redeploy that cash. And the more times you do that, and the longer you wait, the quicker you get there. For me, I did not take $1 out of my real estate for the first 7 years I invested.
No. It's a discipline, and you have to be, not to be obvious, very disciplined in not being tempted to dip into those things.
And it's really tempting.
Or sell. I mean, there's nothing wrong with selling, don't get me wrong, but when you sell an asset, the cash flow goes away.
And you have to recognize that if you're selling and redeploying, it's different than if you're selling and using it to go on vacation. And I've done both. Yeah. So there's nothing wrong with it. But when you sell an asset and you take the money and you don't reinvest it in something, you are slowing your path to financial freedom.
Yeah.
Or you're reversing it, in fact. You could be financially free, sell an asset, spend it on a jet, and now you're not financially free anymore.
Yeah. No, but you'd have fun for maybe the first week.
It might be fine. It might be fine until you run out of gas and fall out of the sky. On that note, I hope you join us next time on the Old Fashioned Real Estate Show. And the way you're going to do that is by not falling out of the sky.
That's right.
So, cheers.
Cheers.